Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So long end bond yields, the 30-year, actually hit 5%. It touched 5% and then got rejected quite quickly. And the long end bond yields basically have been going up rapidly on this idea that, hey, maybe, just maybe, we might see this aka soft landing. Now, the soft landing narrative, if it continues to be true, then you're going to see the long end bond market really test those higher yields. And if those higher yields continue to go up, that means bond prices are coming down. And what's happening is it's causing a steepener in the yield curve because the short end is not moving that much, because mostly yields are being driven and price movement in the bond market is being driven more long end. Now, a lot of people are saying, hey, these are amazing opportunities to go out there and start buying bonds, buying the long end, which may be true because the long end, the long end for bonds have been selling off quite a bit, and you do see quite the discount. However, it may not mean that this is the end in the sell-off in the bond market. If data continues to be strong, inflation comes in hotter than expected, you can expect those bond yields to continue to creep up above 5%. Like we heard from Bill Ackman that we could see 5.5%. Some even think we could see 7% in the bond yields, right? Is it true? Is it not? We'll see. But the thing is, the key is, what happens if everything's fine, the narrative is fine, the economy is fine? What happens if those bond yields continue to go up, especially the long end? That means your mortgage is going to go up, right? Especially if you have to come and renew it in the coming months or next year. If those bond yields continue to go up, especially on the long end, who knows, in the US, you could see double-digit mortgage rates, right? Now, the other argument is that if these bond yields continue to spike and continue to go up further, wouldn't that break something? True, right? Like we saw during the regional bank crisis, and like we saw also last year with the UK pension funds, the LDIs, basically plummeting because bond yields were going up. And now we're at levels back at those in the UK, back at those LDI levels where the UK pension funds were in trouble. And in the US, we're making higher levels in those yields. And the yield curve is right back at the regional bank crisis of this year. So could something break? Definitely, certainly. Right? If these bond yields continue to go up, who is the one that's going to face the pain and the pinch? Who's going to implode? When are we going to see that implosion? It can come. It can come in the next 1 month or 6 months, next year. And the most important thing is that the bond market on the long end can continue to sell off, especially if Powell or the central banks don't intervene and don't do anything. That means they don't cut rates. They keep rates where they are. They hold it and let the economy go through a disastrous, cycle, the recession. So if they don't intervene fast enough, then that will continue the steepener that is caused by the long end, and you'll see those bonds continue to sell off as they price in, okay, we're not going to see higher inflation. Now, could it stop because of the recession with the flight to safety narrative? Sure, you could see it top. So let me correct myself, actually. If we do get a implosion in the markets, and we do see those bond yields spike up, and the Fed's not doing anything, then that could create a top in those yields, or maybe not, right? We'll see. It could bring in a different scenario there, but history suggests that usually you get a flight to safety scenario there, where then people start going into buying bonds, and especially more of the long end, and that causes the prices to move up and the yields down. But then that would bring a flattening in the yield curve. So in order to get the steepening again, you need to cut rates, which then maybe the central bank may intervene later, if not early. And that might cause the yield curve to steepen even further, right? So sorry, correction there on the long end on the recession. Not that the bonds can sell off. Yes, if you get the flight to safety kind of thing, that could bring in a bid into the bond market. But it will be interesting if the Fed doesn't intervene, and if inflation stays sticky, how long will that bid last or stay for on the long end, right? And if you want to get the steepening to be maybe continue, you'll probably need the short end yields to come down drastically, and that will only come from rate cuts, right? So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.